Gold is really interesting because it's one of the few assets where its value depends solely on other people's opinion, right? Whether it's a company or an apartment building, you have an income stream you can value. Gold has no value other than what other people want to pay for it. So if you feel like you're really good at guessing what other people will pay for something, go ahead and buy gold and have fun. But if you don't think you have any skill at that, so history has shown, even in the Weimar Republic, when people were running around with wheelbarrows full of Deutschmarks, stocks were a better inflation hedge than gold.
Well, would you agree, though, with some strategies for exposure to gold, like buying mining companies since they're a little bit of a proxy to gold, or buying gold ETFs?
So that's interesting. So a gold ETF is the same as buying gold bullion, right? There's no difference there. A mining company, if you're a skilled analyst and you think that the value of the assets that are underneath the ground, their reserves, or because of their hedge book, are not being recognized in the stock price, I can see some ways to make money there.
Okay.
But pure gold is really just a bet on other people's opinion.
All right, a bad idea. Okay, Pat, you say a good idea is to buy into emerging markets. So Julie has been looking into that.
Well, there are a lot of people actually who have been getting back into emerging markets. If you take a look at the iShares Emerging Markets Index for the year to date, it really had a terrible first quarter, in part because of concerns about Ukraine, for example. We saw a lot of selling in this particular ETF. But in the beginning of April, we really saw a boost in inflows here, with a lot of investors coming back into emerging markets, in part because they viewed them as relatively cheap if you look at them versus some of the other global markets. However, there was a story in Barron's over the weekend pointing out some of the pitfalls of this strategy. One of the things they cited is that this particular fund actually turns over every 13 days or so, meaning that there's still a relatively high level of skittishness about geopolitical elements and the effect that they have on these emerging markets. Betty.
So is it buy emerging markets, but as long as you have an iron stomach, Pat?
Well, an iron stomach, and frankly, don't buy the index, because the EEM, the MSCI Emerging Markets Index, is very heavily weighted in companies like Samsung, companies that make minerals all over the world, companies like Gazprom, which really aren't emerging market plays. They're either commodity companies or global companies like Samsung. What you want to buy are funds or ETFs that focus on smaller companies that are tied to their domestic economies. That's where you're going to get more consumer exposure, more industrial exposure, and ties to that rising power of the middle class, which really is the long-term theme in emerging markets, much more so than trying to make a play on where iron ore is going to go.
So true emerging market companies, ETFs that are tied to true emerging market companies.
Exactly. There are a couple small cap ETFs out there. Also, I would look at active management here simply because it's a very inefficient asset class, and paying 1% or 1.5% to a well-run, actively managed mutual fund really can add a lot of value over that index that is just, Gazprom, Samsung, giant financials, and commodity companies.
Well, back home in the U.S., we're, of course, closely watching the earnings season, and economics editor Mike McKee. Mike, you've been looking at earnings.
Yeah, and Pat, your call is that at the moment we're seeing little change in the way earnings break down, with tepid bottom line growth, but generally increasing margin. Companies still taking the money and putting it into shareholders as opposed into going into their employees and labor at this point. But that's forecast to change. We're expected to see sales growth rising much more significantly as the next couple of quarters go on. Is that going to change your strategy?
That would be wonderful if we see it, because that really has been the Achilles heel to the recovery in corporate earnings in the U.S. It really has been powered much more by rising margins and returns of capital to shareholders than it has top-line growth. And that's been wonderful for the past 3-4 years of the recovery. But as you point out, eventually you need top-line growth to keep earnings growth going, because the margin stone can only be squeezed so much. So top-line growth over the next couple of quarters, people have been forecasting that for quite a while. I would love to see a resurgence of that.